Forex, short for foreign exchange, refers to the global decentralized market where various currencies are bought and sold. It is the largest and most liquid financial market in the world, with participants including banks, financial institutions, corporations, governments, and individual traders. The Forex market operates 24 hours a day, 5 days a week, allowing participants to trade currencies at any time. The primary purpose of Forex trading is to facilitate international trade and investment by converting one currency into another. However, Forex trading also provides opportunities for speculators and investors to profit from currency price fluctuations. Here are some key aspects and concepts related to Forex trading. 1. Currency pairs. In Forex trading, currencies are always traded in pairs. Each pair consists of two currencies, with the first currency being the base currency and the second currency being the quote currency. The exchange rate represents the value of one currency relative to another in the pair. 2. Bid and ask prices. Forex trading involves buying one currency while simultaneously selling another. The bid price is the price at which a trader can sell the base currency, while the ask price is the price at which a trader can buy the base currency. The difference between the bid and ask prices is called the spread. 3. Leverage and margin. Forex trading often involves the use of leverage, which allows traders to control larger positions with a smaller amount of capital. Leverage is a loan provided by the broker, and it amplifies both potential profits and losses. Traders are required to deposit a certain amount of capital, known as margin, as a form of collateral to open and maintain positions. 4. Market participants. The Forex market consists of various participants, including commercial banks, central banks, institutional investors, retail traders, and speculators. The actions and decisions of these participants, along with economic and geopolitical factors, influence currency exchange rates. 5. Fundamental and technical analysis. Forex traders analyze various factors to make trading decisions. Fundamental analysis involves evaluating economic indicators, news releases, monetary policies, and other macroeconomic factors that impact currency values. Technical analysis involves studying historical price charts, patterns, and indicators to identify trends and potential trading opportunities. 6. Trading platforms. Forex trading is typically conducted through online trading platforms provided by brokers. These platforms offer real-time price quotes, charts, news feeds, and trading tools to execute trades, manage positions, and monitor the market. 7. Risk and volatility. Forex trading involves inherent risks, including currency price fluctuations, leverage-related risks, and market volatility. Traders need to understand and manage these risks effectively through risk management strategies, such as setting stop-loss orders and employing proper position sizing. It's important to note that Forex trading carries risks, and success requires knowledge, experience, and careful decision-making. Traders should consider their risk tolerance, financial goals, and seek appropriate education or professional advice before engaging in Forex trading activities. Regulation of the Forex market varies across different countries and jurisdictions. Traders should choose reputable brokers regulated by recognized authorities to ensure fair trading practices and the safety of their funds. If you like the video, please subscribe the channel and hit the bell icon.